Wall Street investors are increasingly scrutinizing the short-term rental market, with market data revealing potential vulnerabilities that sophisticated investors may be positioning to capitalize on. As vacation rental supply continues to outpace demand, financial analysts are warning that current market conditions mirror warning signs from previous asset class corrections. If you're watching this video, you probably know something is wrong with the vacation rental market. Maybe you own a property yourself and have noticed bookings drying up. Maybe you've seen your neighbors quietly listing their Airbnbs for sale. Or maybe you've just heard whispers about the Airbnb apocalypse coming. What you probably don't know is that while everyday investors like you were buying properties, sophisticated investors were beginning to take a more cautious approach to the sector. What we're about to show you isn't speculation. It's documented market data happening right now, visible to anyone who knows where to look. Let's discuss exactly how market conditions are creating potential vulnerability in the short-term rental sector, and why your vacation rental investment strategy might need reconsideration. Let's start with what we know for certain. According to AirDNA market reports, short-term rental occupancy rates have been declining. The nationwide average occupancy rate has dropped significantly from the post-pandemic travel boom highs of around 80% to approximately 58% currently. Data from the National Association of Realtors shows that in popular vacation destinations, inventory has increased substantially, with many former short-term rentals converting to traditional sales listings. Let's look at some specific markets where the decline is most pronounced. In Nashville, Tennessee, a city that saw explosive growth in short-term rentals between 2018 and 2022, occupancy rates have fallen by nearly 18 percentage points from their peak. The city now has over 7,000 active Airbnb listings, but average occupancy has dipped below 55% for the first time since pre-pandemic levels. This has led to a 23% drop in average revenue per available listing. Sedona, Arizona presents another troubling case study. This desert destination was among the hottest Airbnb markets during the pandemic as travelers sought outdoor getaways. Today, occupancy rates have fallen from 78% to 62%, while the number of listings has increased by 34%. The result? The average daily rate has decreased by 15% year over year as hosts compete for a shrinking pool of guests. The Florida Keys, long considered a bulletproof vacation rental market due to strict permitting that limited supply, has seen occupancy rates fall from 84% to 71% over the past year. Even with constrained supply, revenue per available night has declined by 9%, signaling weakening demand even in historically strong markets. Consider Austin, Texas, where the post-pandemic tech boom fueled a short-term rental gold rush. The market now faces a 41% increase in listings compared to 2019, while occupancy rates have fallen to just 54%. Many investors who purchased at the market's peak are now underwater, with average monthly revenue covering just 60% of carrying costs for recent purchases. But here's where things get interesting. While these statistics are concerning enough, financial markets show signs of growing skepticism about the sustainability of the short-term rental boom. Airbnb's stock performance has been volatile, with institutional investors showing increased caution toward the sector. This reflects growing concerns about the company's growth trajectory and the overall health of the short-term rental market. Public market signals can often foreshadow private market trends. When sophisticated investors grow cautious about companies like Airbnb, it often indicates broader concerns about the ecosystem those companies represent. The pattern extends beyond tourist hotspots. Even traditionally strong urban markets like Boston and San Francisco are showing weakness. In Boston, new regulations have limited growth in listings, yet occupancy rates have still fallen by 11 percentage points year over year. San Francisco, despite having 33% fewer listings than in 2019, has seen average daily rates drop by $42 over the past year as demand fails to return to downtown areas. Rural Zoom towns that boomed during remote work trends are particularly vulnerable. In the Poconos region of Pennsylvania, listings have increased by 77% since 2019, while occupancy rates have fallen from 73% to 49%. This has created a perfect storm where many recent investors are now forced to cut prices dramatically or face negative cash flow. Lake Tahoe provides another stark example of market deterioration. Split between California and Nevada, this region region saw a 112% increase in short-term rental listings since 2019. Today, occupancy rates have fallen to just 52%, while average daily rates have dropped by 19% year over year. Local real estate agents report that former short-term rentals now represent 28% of all residential listings in South Lake Tahoe, creating downward pressure on home values. Financial institutions are also monitoring regional banks with exposure to vacation rental mortgages. According to Federal Financial Institutions Examination Council data, smaller regional banks and vacation destinations have vacation rental mortgage exposure significantly higher than the national average. This concentration of lending in potentially overheated markets creates vulnerability if the short-term rental market cools rapidly. We recently spoke with a former investment analyst who now consults on real estate market trends. For professional reasons, they asked to remain anonymous. The data shows vacation rental owners face a unique set of challenges. Unlike traditional real estate investors, they require specific occupancy thresholds just to break even on mortgage payments. Many bought at market peaks with projections based on 2021's record-breaking travel numbers, which may not be sustainable. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Financial market participants aren't placing random bets. They've identified 3 specific vulnerabilities in the short-term rental market that create what one real estate market analyst described as a perfect storm for potential correction. Vulnerability number 1, the refinancing wall. According to Mortgage Bankers Association data, a significant percentage of vacation rental loans originated between 2020 and 2022 were written as adjustable rate mortgages. This means many vacation rental owners who purchased during the boom are facing refinancing at dramatically higher rates within the next 24 months. With the Federal Reserve signaling rates will remain elevated for the foreseeable future, these owners face substantial payment increases upon adjustment. For a property with a $500,000 mortgage, that's potentially thousands of dollars per year in additional carrying costs. The data from Palm Springs, California illustrates this perfectly. This desert oasis saw a 64% increase in short-term rental permits between 2020 and 2022. Today, 35% of those properties are financed with adjustable rate mortgages set to reset in the next 18 months. Average monthly revenue has declined by 22% year over year, making the coming payment increases potentially unsustainable for many owners. Vulnerability number 2, the supply-demand imbalance. Data from AirDNA shows that from 2019 to today, the supply of short-term rentals in the U.S. increased significantly, while demand growth has been more modest. Simple economics tells us what happens next. Prices fall. Average daily rates have already declined year over year, with metropolitan markets seeing even steeper drops. Several major cities have seen double-digit ADR decreases, according to recent industry reports. The Smoky Mountains region around Gatlinburg and Pigeon Forge, Tennessee, exemplifies this imbalance. According to AirDNA data, the number of active listings has increased by 89% since 2019, while total nights booked has increased by only 42%. This has pushed occupancy rates down by 12 percentage points and reduced average daily rates by $24 year over year. In Joshua Tree, California, another pandemic boomtown, the imbalance is even more severe. Active listings have grown by 300% since 2019, while demand has increased by only 128%. New construction specifically intended for the short-term rental market has created an oversupply crisis, with occupancy rates falling from 76% to just 48% over the past year. Vulnerability number 3, the institutional investor advantage. Perhaps most concerning for individual owners is that large institutional investors now control an increasing portion of the U.S. short-term rental market, up from a negligible percentage just a few years ago. These companies have economies of scale that individual owners simply can't match. When the market contracts, these institutional players can operate at thinner margins, potentially outlasting individual owners and then acquiring their properties at distressed prices. Scottsdale, Arizona provides a clear example of this dynamic. Large property management companies like Vacasa and Sonder now control 22% of the market's short-term rental inventory. These companies have negotiated preferred rates with cleaning services and maintenance providers that are 30 to 40% lower than what individual owners typically pay. As occupancy rates have fallen from 82 to 69%, these institutional operators can still maintain profitability while individual owners increasingly face negative cash flow. But here's where the story gets even more interesting and concerning for vacation rental owners. Market data indicates a shift in institutional investment strategy. SEC filings and analyst reports reveal that some institutional investors have been rebalancing their hospitality exposure, reducing positions in short-term rental-focused companies while maintaining or increasing positions in traditional hotel chains. This suggests sophisticated investors aren't betting against travel itself, just recalibrating their expectations about the short-term rental model. The volume of these market realignments is significant. The shifts in capital allocation and investment positioning suggest that institutional investors see vulnerabilities in the vacation rental sector that individual investors may not yet recognize. To put that in perspective, the scale of this repositioning signals genuine concern among professional market participants, similar to early warning signs seen before previous market corrections in other asset classes. And just like in previous market cycles, financial instruments exist that allow sophisticated investors to capitalize if their predictions prove correct. Derivatives, options, and other financial products provide mechanisms for institutional investors to profit from market corrections, even while maintaining diversified portfolios that include long positions in the broader travel and hospitality sector. But why target vacation rentals specifically? Why not bet against the broader housing market? The answer lies in the unique vulnerabilities of short-term rentals. First, they typically have higher loan-to-value ratios than primary residences. The average LTV for vacation rentals purchased in 2021 and 2022 was higher than for primary homes based on mortgage industry data. Second, vacation rental owners face a triple threat that primary homeowners don't: declining occupancy, declining daily rates, and increasing operating costs. Third, and perhaps most importantly, these properties generate no emotional attachment. Unlike a primary residence where owners will do almost anything to avoid foreclosure, vacation rental owners make cold, rational financial decisions. When the numbers no longer work, they sell. The most vulnerable markets, according to real estate analytics firms, are those with the highest concentration of short-term rentals relative to total housing stock. These include several popular vacation destinations where STRs represent more than 20% of the available housing. In these markets, even a modest increase in listings could overwhelm buyer demand, potentially triggering significant price adjustments according to economist projections. Now, you might be wondering, if sophisticated investors are repositioning their capital, why hasn't there been more coverage of it? The answer is simple. Market participants don't advertise their strategic positions until they're fully established. Just like in previous market cycles, early signals often appear in technical market data rather than headlines. But there are signs that this quiet assessment phase is ending. Market analysts have begun publishing research notes with titles like STR Market Vulnerability, Assessing Correction Potential in Overheated Markets. While carefully worded, these reports suggest that vacation rental owners should reassess carrying costs against realistic occupancy projections. So what does all this mean for you? If you own a vacation rental, you're now competing against powerful market forces, not just changing travel patterns, but also the strategic positioning of sophisticated financial market participants who are reassessing the sector's growth trajectory. But like we always say, knowledge is power. Here are 3 actions to consider. 1. Stress test your numbers. Calculate your break-even occupancy at current and projected interest rates. If you need more than 65% occupancy to cover costs, you may be vulnerable. 2. Consider your timeline. If you plan to hold for 10+ years, short-term market fluctuations may not impact your strategy. But if you're counting on appreciation or cash flow in the next 3 to 5 years, reassess. 3. Watch institutional behavior. If companies like Vacasa and Sonder begin liquidating properties in your market, it may signal the beginning of the correction that market data suggests is possible. The vacation rental market isn't necessarily doomed. Many properties in unique locations with strong management will continue to thrive, but market data suggests a significant targeted correction is possible, one that will affect some owners far more than others. Just like in previous market cycles, the winners will be those who recognize the warning signs early. Whether that means adjusting your strategy, selling ahead of the curve, or preparing to acquire distressed assets when others panic, the choice is yours. But one thing is certain, market sentiment is shifting. The only question is whether you'll be caught on the wrong side of what could become the Big Short 2.0. If you found this video interesting, please subscribe, share, and watch this one as well.